Right now, the best strategy is we're seeing the most growth in the A-class space and in the solid B+ space.
This way to kind of get your foot in the door is by partnering with other experienced operators. This is about creating something that's sustainable that we can pass down to our next generation.
Hi, everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Brian and Cody from Blue Oak Capital. Blue Oak Capital is a Houston-based private equity firm focused on acquisition of cash flow producing multifamily real estate across the U.S. They're dedicated to business excellence by creating a culture founded on trust, transparency, integrity, respect, and commitments. Their mission is to strengthen their relationships and partnerships with those around them and help others obtain financial freedom through commercial real estate investing and improve the lives and community in which they serve by providing safe, affordable, and accommodating housing. Welcome to the show today, Cody and Brian.
Thank you for having us, Elisa. It's a pleasure to be here.
Yeah, thanks for having us.
Yeah. Awesome. So today, listeners, we're going to dive into partnerships because we get a lot of questions about how do you find great partners? How do you thrive with partnerships? Partnerships is very scary things for people. So I think Cody, Brian, and also John, who's not here, they created a very workable partnerships together, and then which allows them to acquire how many doors, like over 1,000 doors across the nation over there. So really excited to dive into that topic. But first, Brian and Cody, tell me a little bit about your journey on becoming what you're doing today. Like from your previous life. I would assuming there's a little bit story over there. Yeah.
Yeah, we all come from varying backgrounds. I'll keep mine short. I started a W-2 career in 2008, stumbled into real estate investing by accident in 2010 by becoming an accidental landlord. And it was after that experience where I discovered this power of real estate entrepreneurship. And, all of my upbringing and educational or financial education, I was discovering that was misled. And so started discovering more and more about the power of real estate investing and financial independence, financial literacy, and started pursuing, real estate entrepreneurship as a full-time venture. And so I tried multiple different verticals and strategies in the residential space, tried some other non-real estate related business ventures along that way. And then, just started running into a lot of issues with scalability, wasn't finding any momentum, wasn't finding the economies of scale, wasn't really getting to the point of financial independence that I was looking for. And so that's when I decided to make the pivot to multifamily early 2019, and was fortunate enough to met our first partner, John, through a networking connection. And we started collaborating, working together, formed Blue Oak, and John met Brian through another networking platform. And stars aligned, and we've been off to the races since. So Brian, your story.
Yeah, so a little bit different than Cody. I didn't accidentally stumble into real estate. Mine was a little bit more intentional. So I started in real estate in 2018. I was really looking for something where I could grow and protect wealth. I had kind of been looking around and really trying to connect the dots on what were a lot of successful people doing. And they all seem to have real estate in their portfolio. So I said, okay, well, that seems like a good investment vehicle. Wasn't really attracted to the equities market and a lot of the other verticals that people do for investing. So real estate made a lot of sense to me, especially, cash flow producing assets. So I started going up that ladder, but I had a very limiting mindset. I didn't know what I didn't know. I was in my late 20s at the time. And, really the formula in my head was how many dollars are in my bank account. That is 20% of a property. And that's how I thought real estate worked. You just put 20% down and you buy, a handful of properties a year and you just kind of go from there. But after doing that for about 18 months, very quickly realized that if I wanted to scale and really get those economies of scale, I needed to go bigger. I needed to go larger. It wasn't necessarily about speed. I think we all know, being in this business, real estate is not a get rich overnight business. It's something that takes many, many years of development and of effort and time. But it was more about the economies of scale. It was a lot of work for one person. Obviously, my funds were limited. You can only buy so many houses yourself before you run out of capital. And so I started just looking for other opportunities and verticals. And my goal was to always get into commercial real estate. I love commercial real estate. When I was first studying real estate, before I started in 2018, my goal was to get to commercial real estate in 5 years or less. But after doing single family for a couple of years, I decided, you know what, now's the time. If I'm going to make a change, my wife and I don't have any kids yet. If we're going to take some risks, so to speak, now is the chance. So early 2020, right around the time COVID hit, as Cody mentioned, I met John. They had just formed Blue Oak Capital. They were in a multifamily mentorship group. It was a group that I was coincidentally looking at joining as well. And the stars sort of aligned where they needed somebody on their team that brought a particular skill set. I had that skill set based on my business background that I have. And we all found that we worked really well together, which I think is the most important piece. It wasn't so much the X's and O's and skill sets. It was, do we all get along? Is Cody a guy you want to like hang out with and sort of go to battle with, so to speak? Because we all know this business is very hard. So joined them in early 2020, and we were off to the races. And here we are today, we got 847 doors, give or take, and actively pursuing lots of other opportunities.
Nice, awesome. And then you kind of mentioned about how you first met. So in the sea of, because you go to these conferences, etc., there's basically a sea of fishes, right? Like people who you meet, and then everybody seems really nice, and etc. Like, how did you kind of gravitate and identify with John? Unfortunately, John's not here with us, so I can't see his charm. It sounds like a John is the connect over here. But like, how did you all kind of like, what first struck you as like, this is my person that I want to explore a further relationship with, along with many others?
Cody, I think we like to say it's because we all have beards. I think that's why it all works.
We're cool guys with beards. You can't go wrong, right? No, look, I think it starts with identifying who you are as an investor and what is your skill set and value proposition that you can bring to a team. And I think that's the mistake that a lot of investors make when they're going out there and trying to find a partnership. They really don't know what they're looking for because they don't know who they are. And so that was a key piece for us is, I was kind of starting in multifamily kind of independently as I was trying to find partners. I was just building the business, from ground up, and then connecting with John. That conversation when we sat down to look at, hey, what does a partnership look like? It was very clear as, hey, this is my value proposition. Here's what I can add to this partnership. Here's the other side of that table. Here's what I'm adding as well. And then you can say, okay, do those synergies align? Do those alignment of interest truly, synergize? And can we work together after that? And so that's exactly what we did. We laid out what the value propositions were, but then we put it into practice, right? It wasn't a quote unquote marriage from the beginning. It was, all right, well, let's go through some exercises. Let's look at deals together. Let's, go through some barriers together and see, can we really collaborate effectively? And once we established that, and that was kind of like the solidifying moment of like, okay, this is a true partnership. And really we did the same thing with Brian, right? John met Brian, very similar conversation, and looking at what are the value propositions, and then how does that all align as a team?
Mm-hmm. And then what are some roles and responsibility all three and 3 is a great number for partnerships because you never get into a deadlock. So what are some like different skill sets, personalities that, if you would have described, I'm going to ask Brian, if you would have described Cody, what would you say like his unique ability is that made you decided like, hey, this is the right players to this, and the roles that he plays? This is a very interesting exercise because it may not match with what Cody thinks the roles that he plays.
That's a great question, and I think it's really important. And I see this often from newer syndicators or newer partnerships where, let's say you and I meet for the first time, Elisa, and we're both in acquisitions. We both love deal hunting. We both love talking to brokers. We both love underwriting. And then the question becomes is like, okay, well, there's probably going to be a point in time where one of us finds a deal. Well, then who's going to go raise the money? And then who's going to go manage the asset? If that's not our skill set, then we have the wrong team. I'm not saying you can't have 2, potential deal people on your team, but you have to realize that this business requires a lot of moving pieces. So for us, when I was looking at Cody, I think Cody has that personality. Well, one, he's an easy guy to like, which is great for brokers, right? He's somebody that when you talk to, he has that personality where it's not dry. And brokers are typically very outgoing people. They don't, I'm sure they talk to all kinds of people, but it's nice to have somebody that's good at building relationships. And Cody clearly has that skill set. And for me too, from my customer service background, when you're looking at capital raising, you're looking at asset management. To me, I've grown up in the hospitality industry. That's my background. That's what I've been in for the last 15, 16 years. So I always have a customer service mindset. So when I'm thinking about, raising equity and talking to our investing partners that invest with us, and I'm also thinking about our tenants, that's super important to me, is having that hospitality mindset. So I think when you're looking to build a team, it's really important. To us, there's really three hats. There's obviously more, but for us, it's acquisitions. Are you good at underwriting? Are you good at building relationships with brokers or sellers if you're going off market? Then there's the investor relations, the capital raising side of the business. Can you confidently sit in front of an investor, somebody maybe you just met for the first time, explain your business, come off confident, and be able to nurture a relationship so you can raise capital from them so they can partner with you on future deals? And then there's an asset manager, somebody who understands operations, somebody that understands building teams, managing teams, leading teams, and eventually producing the results that are needed to accomplish the business plan. So those are the three main hats. And when you're building a team, you really gotta find those right complementary pieces. You might have somebody that you love, you want to go grab a beer with, want to go grab dinner with. They're great people, but if they don't complement your team and they don't add value with those right skill sets and those right personality traits, then they might not be the best fit for a long-term partnership. Cody, what would you, anything else to add to that?
No, I think you hit the nail on the head. I mean, I think that's a great summation. And, it's really it comes down to, again, what is that value proposition, and making sure that is a great fit in alignment for the partnership. So well said.
And I'm guessing John is the operation piece, that asset management piece over here for this. Now, interestingly enough, oftentimes during the networking events, you go out there and people are like, okay, my strength is asset management, right? So then you get someone who's like shrugged, is like, well, great, but the deals and the monies are like the ones that kind of making deal. So how does that kind of like plays in your initial interactions where you had the foresight to see like, no, the operation is actually an important piece over here. It's not just the deal and the money, because the person who finds the deal, oftentimes perhaps is not very good at running the deal, right? But that typically is the person by default would be doing asset management as well. So how did you guys kind of have the foresight to say, no, John, you're actually doing the asset management in these pieces?
Yeah. Well, John's role actually isn't on the asset management side. He's actually our corporate operations kind of officers, like what we internally describe him as, and kind of our, I guess, chief investment strategist, if you will. So John's value proposition and our partnership is not time. So when you look at the dissemination of workload between deal sourcing, acquisitions, vendor relations, investor relations, asset management, to be frank, I mean, Brian and I are handling more of the day-to-day responsibilities, or at least what's visibly facing to our market and our community, right? But then there's still a lot of the corporate things that need to be handled, taxes, paper, documentation, filing, all of those different things that you need to operate a business. And that's really John's skill set for us and our team, is not being able to allocate a lot of time into going to build the relationships in our business per se, but handling a lot of the things that are exclusive to Blue Oak Capital as a corporation.
Right.
Yeah.
That makes a lot of sense, because I think when I look at all teams on syndicators that they're successful, typically there is someone who is like CPA background or tax lawyer background or something on the team, because then they understand the asset management part of the thing, which is a lot to do with accounting and numbers. Not necessarily like something else like the physical visiting properties and this and that. I think it's
sure. And one other thing to highlight for John too is, his W-2 background is in commodities trading for a very large oil and gas company. And so every day they're looking at equities markets, they're looking at fiscal policy, they're looking at monetary policy. How does that impact the equities and commodities market, which is very transferable into what drives our investment decision-making day-to-day in real estate. And so that is a huge piece and value to our team, because we're having, especially right now, we're having weekly conversations, almost daily conversations about, economic policy and economic forecast and how do we need to adjust our investment approaches based on what we're finding and experiencing in the marketplace. And so that's a huge value as well.
Yeah. And so can you share some of these with our audience over here, going into a market with high inflationary numbers and as well as subsequently higher rates? How are you guys changing your acquisition strategies?
Well, for us, our acquisition strategy actually has not changed. We made a pivot last year, kind of midway through last year, to really focus on what we, the cliche flight to quality, right? Where, quality assets, A, B assets in quality locations that have a stronger, more resilient demographic, so your higher income earning, middle working class type demographic that can absorb a inflationary period like we're experiencing today, right? And if you look at the economic impact from what we're experiencing now, everybody's being negatively impacted. I mean, we're all of our pocketbooks are hurting, of course. But when you have an income earner that's earning $80,000 or $100,000 a year, $4 a gallon of gas doesn't have the same impact as somebody that's only earning, $30,000 or $40,000 a year. And that's what we're seeing in our portfolio as well, is the demographics in our A-class assets are able to, have a little bit more elasticity when it comes to market changes versus what we're seeing in our C-class properties. Brian, you got anything to add there?
Yeah. So Cody and I spend a lot of time on a lot of investment webinars, both for real estate and other things. And we've seen this and we saw it coming because we watch a lot of operators that are where we want to be. And they've all made a very strategic flight to quality. And they were doing it a little earlier than a lot of other operators are doing now. There's more people following this suit. But we've seen data as of recently in Q1 where your A class assets, for example, and your B plus asset had 15, 16, 17% rent growth, where your C class assets were just north of 8. Now, 8% rent growth is still phenomenal, but you have to also remember that inflation is 8.6% the CPI index last month, right? So essentially your C-class assets, yes, your rents are going up, but just enough to keep up with inflation, which is great because real estate is a hedge against inflation. But our strategy that we pivoted to a little over a year ago, we sort of saw the writing on the wall, seeing what the other operators were talking about, and also looking at the data, going back to what John provides a lot of value in, and seeing like, hey, right now the best strategy is we're seeing the most growth in the A-class space and in the solid B plus space. Let's go ahead and shift our focus. Even though these assets are a little bit larger, they have a bigger sticker price, we feel more confident, more secure taking investor capital, being that fiduciary, parking it in a more secure asset over the course of the long haul. And these are the tenant bases, as Cody said, that are going to be able to take those impacts, your workforce housing spaces. That's a tough area. Those guys are getting hit the hardest, unfortunately. So trying to go in there, acquire property, even though you're doing a value add play and maybe you're doing $2-3 million of CapEx, trying to move somebody's rent $200-$300 when they already are barely living paycheck to paycheck, that's a tough pill to swallow. And we didn't want to be caught up in that mix. So that's why we had that pivot to the more quality housing.
Yeah. And then when you talk about quality, there's also location and the physical aspect of quality.
Sure.
So is it kind of more so the A-class buildings in a good location? Is the location more important than the physicality of the asset?
Yeah, 100%. Yeah, I mean, because people are going to want to live in places that are in high demand. A location that's close to large employment centers that have easy accessibility to whatever impacts their day-to-day lifestyle, right? Whether that be activities, jobs, etc. Now, when we talk about location as well, you can get very granular and talk about like specific micro markets and sub markets within an MSA, but as a broader scope, you have to really look at secondary, tertiary markets versus primary markets as well, right? That's another hot topic item right now is, for us in our thesis, looking at risk mitigation, being in a primary market like Houston, where we're based out of, San Antonio, any of the Texas MSAs, really being in a dense populated MSA gives you a lot of security in the long-term execution throughout your business plan, right? You have a diverse economic base here in these MSAs. You have a large, dense population. So your risk mitigation is much lower versus if you're going into a secondary, tertiary market that has a much smaller population, maybe 1-2 economic drivers or employer bases that could be easily impacted by an economic downturn. And so I think it's important to take that consideration. probably more so than the characteristics of the building, because I guarantee you people they'll still rent, a 70s, 80s C-class product in an A-class area,
Right.
if it's convenient for their lifestyle.
Yeah, it's kind of like the hot commodity, because then you can scale down and save money in these assets potentially. And Brian, then have you kind of adjusted the investor expectations due to the recent changes and et cetera? Because we know capital return is probably going to take a longer time, and with the same underwriting, et cetera, and it may not be, because maybe hopefully you are using very conservative underwriting, et cetera, so that is mitigated. But have you kind of adjusted having these discussions with your investors to say, hey, moving forward 5 to 7 years, or perhaps it looks different than the last 5 to 7 years?
That's a great question, and something we're talking about regularly to our investors as well. So one, from a metric standpoint, yes, you do have to adjust expectations, especially if you're looking at an A-class product. If you're looking at something that's 2010s and up, it's not going to produce the same returns as a value add play that was built in the 60s and 70s. Now it's risk adjusted, right? So the risk, there's less operation and executional risk there because you're not doing a heavy capex. So your returns are going to reflect that. So that's important for us to look at. If we see 5-6% cash on cash in an A-class property, we get very excited about that, because again, it's risk adjusted versus maybe a 7 or 8% or higher in a C-class asset. So that's really important. And then two, for us, based on, market cycle is the hot topic right now. Everybody's talking about inflation and all the things going on there. So for us, we're talking to our investors. Our goal is to make sure we stay flexible. So we want to make sure we understand, like, look, what's happened in the last, call it 5 years, where you're selling these properties and doubling your money in 2 years. That's probably not going to be what's happening going forward. So we condition our investors to understand, like, look, these are long-term holds. And by long-term, we just mean we want to execute the full business plan, which might be 5 years, might be 7 years, or maybe it's longer, but we want to have the flexibility to make sure that we can exit when the market is right. I wouldn't say at its peak, because you can't time the market and say it's at its peak, but we want to be able to execute when it makes sense for our investors. So maybe it's 3 years, maybe it's 5 years, maybe it's longer, but keeping that expectation in check is also important. And then also, just depending on, the investment and the opportunity, understanding the expectations as far as cash flow. If we're going in and we're looking at a property that has floating rate debt, for example, in a rising interest rate environment, there might be parts of the deal where maybe cash flow is a little tighter and distributions get held. So these are a lot of common themes that we're hearing around the industry from a lot of operators as well. It's just conditioning their investors to understand, like, look, this is a preservation of capital play. Right now, the equities market has gotten absolutely crushed. If you're in stocks, you're very sad right now. If you're in crypto, you're also very sad right now. So what type of asset class can I look at that is going to at least preserve my capital, and I'm going to get some long-term appreciation in a risk-adjusted basis, in a quality asset, in a quality area, in a quality location, and a growing MSA that has lots of jobs? That's where real estate steps into play. And that's really our strategy and our communication to our investors.
That's right. Yeah. And then I looked at your portfolio. You have one property in Ohio, and then the rest of the remaining of in the Texas, but split between kind of the Dallas-Fort Worth area and the Houston area. How do you manage these distributed assets, meanwhile kind of keeping eyes on scalability?
Yeah, well, looking at the evolution of our portfolio, we were just like anybody else is getting started. The barriers to entry were so high, right? And so the fastest and quickest way to kind of get your foot in the door is by partnering with other experienced operators. And so that's the exact approach that we took. We started partnering with other operators that had successful track records, that had a lot more experience than we did, that we could add value to and their team. And in this case, bringing our equity and our investor database to some of these deals. And so, the deals like in Columbus, Ohio is a great example. Dallas, a great example, where that was partnerships with experienced operators who had experiences in those MSAs or those markets that we could participate on, even as co-GPs, right? As co-general partners. And so they're the lead sponsors. They're more responsible for like the day-to-day asset management, so to speak, and things like that. And we're just an integral part of the team as co-general partners. But when it comes to our acquisition pipeline, obviously we're focused just here in Central Texas, Houston, San Antonio. But that's kind of really how we we look at the diversification of our portfolio across multiple markets is having boots in the ground, having other experienced partners that are in those target markets that really we can rely on to disseminate the workload across.
Yeah, and I think it's important to highlight, no matter where you buy a property, you're probably not there every day, right? So it's not like you're on site every day. So you really have to have systems and processes in place, whether, on your weekly asset management calls, your follow-up kind of in between your calls, regardless if you can get out to the property or not. Like Cody mentioned, you want to have a great partner on your property management side. So you want to make sure you're hiring a property manager. If you're using third-party property manager that has a footprint in that market, you don't want to be their first customer and that has experience in multifamily in particular, especially if they're larger assets. So that's really important, having that quality partnership on the asset management side. And then you definitely want to have somebody that's boots on the ground, that lives in that market, somebody that can be in the, be by the property within a matter of hours if necessary, just in case, there was you need to be there. So as long as you have those two things, it doesn't really matter as much. You don't want to scatter yourself too thin. Obviously you want some economies of scale trying to invest in the same market, but it doesn't really matter where you invest from. There's tons of people investing all the way across the states. We know people that are in Europe investing in the US because they follow good systems.
Right. That's amazing. Know the person investing from Europe too, directly into US. That sounds like a really far. We actually have an episode on that too. But interestingly enough, so what is your next set of goals? What's your next set of like a large goals? In terms of your growth of the companies and etc.
Cody's going to buy the whole city.
Yeah, I'm trying to buy all of Central Texas, but it's the capital markets are definitely throwing a wrench in that for sure. So, we did a total of $105 million in acquisitions last year across our partnerships, right? And so this year, our big goal was to get to 100 million in acquisitions again this year. And, obviously things have changed and we're off to a little bit slower start than we were hoping. But that's really the next big milestone, is let's get to the next 100 million in acquisitions. And then from there, really talk about more vertical integration. So bringing things like property management in-house, maybe even construction in-house at a later time, but really getting to that point of economies of scale to where we can start bringing in those resources versus outsourcing them, and which will give us even more of a competitive advantage. So.
Yeah, I think continuing to grow our team is also on the very short list of things to do. We're looking to make some hires and things within the next 12 months to continue to layer on infrastructure and systems so we can have even better service for our residents, better service for our investors, and then continue to grow our pipeline.
Yeah, definitely. That's awesome. And then what is the kind of the end goal? Is there any end goals to that, or your BHAG, which is kind of like the big audacious goal for y'all?
Yeah, it's kind of funny. Look, from a company standpoint, I think, Brian, you would agree. We talk about this a lot. We would love to get to that $1 billion mark, right? Where you have a sustainable business that has grown to $1 billion portfolio in assets under management. But I think really this is more about, the term that you hear often, the legacy wealth, right? This is about creating something that's sustainable that we could pass down to our next generations, our kids and things like that they can be involved in. So that way we can change the course of their financial future. And I think that's really the big goal, is just getting to the point of scalability to where this is something that can be passed down to generations to come.
Yeah, I think our goal is, I'll use the word impact. We just want to have the biggest impact that we can. We want to impact our residents in a positive way. We want to impact our investors in a positive way. We want to help them protect and grow their wealth. And then we want to impact people that decide to partner with us and that work with us, whether they're an employee who works for us when we have a property management company one day, or they're an investor relations or an analyst or whatever it is. We want to have as positive of an impact as we can. And then obviously we know the more people we impact, the more it's going to benefit not only the company, but the people that come along for the journey and our families as well, long-term.
Absolutely.
Yeah, definitely. And this sound like Cody has kids. I don't know if, Brian, you have kids.
Not yet. Cody's got plenty.
All right. So what are you doing today to help your children to be more financially literate?
Well, it's kind of funny. We laugh about this, right? Because I'll take my kids on property tours. And then my oldest, who's a teenager, trying to start getting him involved in some of the day-to-day stuff, looking at financial reports, reading some of the financial books that support real estate investing, and just really trying. Right now, the big thing is just trying to shift the mindset and mold the mindset around being financially independent and not being a W-2 employee for the duration of his career. If he wants to go that route, fine. But the point is, I want him to learn that you don't have to be dependent on a fixed income to find that financial freedom. But it's really just getting them exposed to what dad does every day, taking them on property tours, taking them to some meetings. They see me on podcasts and things like that. And they always ask, well, what is that? What are you doing? And just really keep just showing them what it is that we're doing day to day.
Yeah, that's amazing. Awesome. How does our listener find you?
Well, we're definitely not hard to find, especially Brian and I. We're kind of all over the place. You can definitely connect with us on social media through our Facebook, LinkedIn platforms. But if you really want to connect with us directly, the best way is to email us directly, Cody or Brian at blueoakinvest.com, and connect with us there. We'll make sure to we'd love to get an introductory call set up with you, and also share some valuable resources that might help your investing.
Yeah. I'd love for anybody to shoot us an email directly. We've got some great content. Love to share some of our resources on why we think partnering with us and investing in Texas in a great market makes a lot of sense for you. So if you're interested and you have questions, shoot us an email, Brian or Cody at blueoakinvest.com with an S at the end, and we'll be glad to share those resources with you.
Yeah, awesome. And we're going to put that on our show notes as well. Well, thank you so much today for your time, Brian and Cody. We look forward to chat with you soon again. And this wraps up another episode of 10,000 Roads to Financial Independence.